Well, someone else is going to be handling that one way or another, it seems. Neil, Dutta, what do you make of what we got in the data today, the best data that we have at the moment anyway, and what investors should really take away from it about the state of this economy and the market?
Well, I think for the Fed, it feels a little bit like deja vu all over again, because this is kind of where we were around the same time last year. Things sort of seem okay, and then you kind of get punched in the face with a weak jobs number. And, make no mistake, the jobs number was weak. It wasn't just about the revisions, which tend to be cyclical in nature historically, right? So in good economies, data tends to get revised up. In bad economies, data tends to get revised down. But I think what's important is that the prime age employment rate, so those aged 25 to 54, that employment rate is down about 0.5 percentage point against last year. That is not typical for a good economy. There's been a lot of kind of rationalization away of the jobs number. Well, it could be immigration and so forth. If you look at college unemployment rates, they're clearly going higher. I mean, so to me, like using immigration as a rationale to kind of wish cast away the jobs data, I think is a mistake. So, to me, the Fed is in a pickle, I think, because inflation numbers might get a little worse over the summer. But ultimately, for me, it's about the nominal anchor. And it's pretty clear that nominal incomes are slowing. And so I think Governor Waller, as an example, is on very, very solid ground. Ultimately, I don't think consumers really have the capacity to absorb higher prices. And as a result, I think the Fed's going to be cutting in September.
Yeah, of course, it was interesting to get those statements from Waller and Bowman today on the heels of that data. Neil, I mean, just to put a finer point on it then, if you have a labor market that's weakening, and if it continues to weaken, doesn't that actually mean slower consumption, which in turn slows the economy and ultimately could slow the pace of price increases?
Well, we've already had slower consumption. I mean, that's the sort of nasty little secret. If you look at the first 6 months of this year, real personal consumption is actually down, okay? That's not widely known, but you have basically, I think, three economies, Morgan. You have housing, which I think is in recession. Single-family permits are down quite sharply. The consumer is, on very, very thin ice. Real spending is down. Even in services, by the way, it's weakening quite notably. You can't really shift that around because of tariffs. And then, on the final piece of it is this AI boom, which has been spectacular. But ultimately, I think broad CapEx outside of AI tech, that's going to be sluggish because ultimately, if companies feel less good about the outlook, they tend to spend and invest less. So that's what I anticipate going forward.